SpaceX just went public. And right now, millions of people are staring at their phones watching SPCX climb. Some of them are about to make a very expensive mistake. Not because SpaceX is a bad company. It isn't. By almost any measure, it's one of the most extraordinary businesses ever built. It launches more rockets than entire nations combined. Starlink now serves over 10 million customers across more than 150 countries. The defense contract pipeline is deep and growing. This isn't a video about the rockets. This is about the document nobody is reading, because buried inside the prospectus SpaceX filed with the SEC, a public document anyone can download right now, there is a mechanism that turns today's price pop into something very different from what the headlines are calling it. By the time this video ends, you will have specific dates on a calendar, and those dates will matter more to your money than anything you've seen on a ticker today. Let me start with a number. SpaceX went public at a valuation of approximately $1.75 trillion against last year's revenue of roughly $18.7 billion. That's about $94 of valuation for every single dollar of sales. 94 to 1, for a company that is currently losing money. To put that in context, one of the most respected independent research firms on Wall Street ran a detailed independent valuation of SpaceX and concluded the company is worth closer to $780 billion. That's more than half below where it's trading today. So when I say there's a gap between a great company and a great deal, that gap has a number, and that number is roughly $900 billion. Now let me explain the mechanism, because this is the part the headlines aren't covering. When a company goes public, only a small slice of its shares actually starts trading on day one. In SpaceX's case, that slice is approximately 5% of the company. The other 95% is still held by the people who got there first, the founders, the employees, the venture firms that funded this company over the years. Those insiders are not allowed to sell yet. They're contractually locked up. The reason is simple. If everyone holding cheap shares could dump them on day one, the supply would crash the price immediately. So almost every major IPO uses what's called a lockup period, usually 180 days, to hold that supply back. Here's where SpaceX did something unusual. Instead of one single cliff at the end of 180 days, the way Rivian did it, the way Uber did it, the way almost every major IPO structures it, SpaceX built a staggered release schedule, 5 separate tranches that unlock at fixed intervals, 2 additional cliffs tied to earnings reports, and 1 performance trigger tied to the share price itself. That last part is the one worth slowing down for. Here's what the prospectus actually says. If SPCX trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings report, an additional 10% of insider shares unlock for sale early. Read that again. 30% above the IPO price. 5 of 10 consecutive trading days, 10% more insider supply gets released early. The IPO price is $135. 30% above that is $175.50. That's not a theoretical number, that's a specific price. And every trading day SPCX closes at or above 175.50 counts toward the 5 out of 10 requirement. SpaceX opened this morning at $150. The trigger sits 13% above where the stock opened. One good week. That's all it takes. So the day one pop, the thing everyone is celebrating on social media right now, isn't just a celebration. It's a countdown. The harder the stock runs in the first few weeks, the faster 10% of locked-up insider shares become eligible to sell. Now let me show you the calendar. Today is June 12th, day 0. SpaceX is publicly traded. 5% of the company is in the float. 95% is locked up. Let's walk forward. August 21st, day 70. The first of 5 staggered tranches unlocks. 7% of insider shares become eligible for sale. September 10th, day 90. Second tranche, another 7%. September 25th, day 105. Third tranche, 7%. October 10th, day 120. Fourth tranche, 7%. October 25th, day 135. Fifth tranche, 7%. That's 35% of insider shares released across 5 dates between late August and late October. And those are just the time-based unlocks. 2 more cliffs land somewhere in between, tied to earnings reports. The first cliff fires 2 days after SpaceX reports its first quarterly earnings as a public company. That's the quarter ending June 30th. Earnings could land anywhere from mid-July to late September. Whenever it lands, 2 days later, an additional 20% of insider shares unlocks. 20% in one day, bigger than any single staggered tranche, And the exact date isn't fixed in advance, which means the moment it actually arrives is something most retail buyers won't be tracking. The second cliff is even larger. 2 days after the Q3 earnings report, the quarter ending September 30th, another 28% unlocks. Then December 9th, day 180, the standard lockup expiration. Every restriction that hasn't already lifted lifts now. Add it all up. 5 tranches at 7% each is 35. The Q2 cliff is 20. The Q3 cliff is 28. That's 83% of insider shares, released before the calendar even hits day 180. The final 17% unlocks at the standard expiration. By mid-December, 6 months from today, every restriction on the staggered schedule has lifted. 6 months. That's the timeline worth thinking about, not whatever the stock does in the first hour of trading. Now let me show you what has happened to other companies when their lockups expired. Because this part matters. Palantir went public in September of 2020. Retail enthusiasm pushed the stock from around $10 at listing to levels near $40 by early 2021. Then the lockup expired. Insiders, including Peter Thiel, sold tens of millions of shares into the premium that retail buyers had built. The stock fell 13% in a single session and spent months recovering. The expiration date was printed in the prospectus from day one. Almost nobody buying at $38 was tracking it. Rivian went public in November of 2021. Opening day was one of the most exciting in recent memory. The stock jumped 22% above its IPO price, and a lot of buyers took that pop as proof they needed to get in fast. 6 months later, the lockup expired. Ford disclosed it would sell its entire stake. The stock dropped 20% in a single day. Over the year that followed, it fell 67% from where it had peaked. Every one of those dates was visible to anyone who looked. Uber went public in May of 2019 at $45 a share. By the time its lockup expired in November of that year, the stock had been struggling, and on the very day insiders were finally allowed to sell it, hit an all-time low. 40% below the IPO price on the expiration date itself. The pattern across all of these is clean. The higher the speculative premium at the IPO, the more painful the expiration tends to be. SpaceX is going public at roughly 94 times last year's revenue, the highest premium of any major IPO in years. None of those companies were bad businesses. Most are still around. Some have recovered. The point isn't that SpaceX is going to collapse. The point is that the part of the deal that hurt retail investors in every one of those names, the unlock, is the part that is still ahead of us in this one. Now let's talk about Elon Musk specifically, because there's a date in the prospectus most people haven't noticed. June 13th, 2027, day 366. That's when Elon Musk's lockup ends. Musk cannot sell a single share for a full year. Not at day 70, not at day 90, not at the Q2 cliff, not at the performance trigger, not at the 180-day expiration. He is locked out of all of it. Every headline tomorrow will call that a positive signal. And on its own terms, fair enough. The founder isn't dumping shares on day one. That matters. But here's the part that doesn't show up in those headlines. Every other insider, the early employees, the venture firms, the executives below the very top, is on the staggered schedule we just walked through. Their first chance to sell starts somewhere in the next 70 days. By the time Musk's lockup even begins to lift, the rest of the insider base has had a full year of unlock windows to sell into retail demand. A full year of opportunities for the people who got there first to sell to the people who got there last. The person at the very top is protected. The people in the middle get multiple exit windows over the next 6 months. The person buying today on their phone watching the ticker climb is the demand all those exits are pointed at. Same prospectus, same company, 2 completely different deals depending on which side of the lockup you're on. So where does that leave you if you're genuinely interested in SpaceX? Because understanding everything I just laid out is not the same as saying you should never own it. There are 3 paths. The first path is to chase the hype. Buy today at the popped price before the trigger window opens and the staggered tranches start unlocking. We've now seen exactly why that's the weakest seat in the house. The second path is to write off the whole thing forever on principle, which throws out a genuinely remarkable business because the deal structure was unfair on day one. That's not necessary either. The third path is quieter, and it costs you nothing but patience. You let the calendar do the work that hype is trying to rush you past. 6 months from now, every restriction on the staggered schedule will have lifted. The Q2 earnings report will have landed, real numbers you can hold the company to. The Q3 earnings report will have landed too. The performance trigger window will have closed one way or the other. Every one of those events is a piece of real information replacing speculation. None of that requires you to predict anything. It just requires you to not be in a hurry. Here are the dates worth marking. Late August through late October. The staggered tranche window. 5 dates. 7% each. Mid-July to late September. The first earnings report. Watch what gets disclosed. Watch whether the performance trigger has fired. Mid-October to late December, the second earnings report. Watch the Q3 numbers. December 9th, the day the standard 180-day expiration arrives, and the last 17% of insider supply is free to trade. By the time that final date passes, the price will reflect 6 months of reality instead of 1 day of hype. That's the price worth deciding on, not the one on your screen right now. Here's the thing worth holding on to. The best companies of the last few decades stayed investable for years after their IPOs. You did not have to own them on day one to do extraordinarily well. The market rewards the patient far more reliably than it rewards the early. The thing being sold to you today as a once-in-a-lifetime act-now moment is almost always a stock that will still be there next quarter, at a price set by reality instead of by a countdown clock. The most important habit in this entire video wasn't the calendar. It was learning to look at deal mechanics before deal headlines. The trigger clauses, the unlock schedules, the float math, the index inclusion rules. They're all sitting in public documents, available to anyone, before the price action ever starts. The advantage isn't access to information. The advantage is reading it. If this changed how you think about IPOs, not just this one, but any one, subscribe. Because next week we're applying the same lens to the next big deal coming down the calendar. See you then.